Hopefully people are not planning their portfolios as if this is a New Year's Eve party. They're going to do something at the exact end of the year. You know, they need to be invested permanently to some extent. They can go up, they can go down in terms of risk allocations, but knowing that exact moment when financial markets range around it, you know, it's pretty key not to plan portfolios that way.
And you're completely right. So this is my question about a lot of these international markets.
Right.
The same criticism could apply. It's impossible to ever know which of them to be in for a given year. So do you think people should be in all of them all the time, or none of them none of the time?
Not all of them all the time, but I think most investors concentrate on one market where they feel most comfortable with. Home bias means that they take more local idiosyncratic risk with events that go on. To be fair, American investors have had the best performing market and the best performing economy for the past decade. They've had the best performing financial market for the last 100 years. But I think something that Mike Santoli just mentioned is very important here. If you take a look at trailing 10-year returns, the best performing asset class of the last 10 years, small cap U.S. stocks. Number two, large cap U.S. stocks. And we've never seen a decade in which the asset class that performs best goes on to subsequently be the best performing market in the subsequent 10 years. We have decades of data that show that.
So you're just saying don't pile into small caps right now, thinking that that's going to, you know, be the outperformer for the next
Well,
few
this
years.
particular one is focused on the fact that most of the smaller companies are more indebted. It's across sectors. You know, the next Netflix probably in there, but the same with some of the companies that are on their way down in terms of balance sheet. At this late in the cycle, we want to be a little bit more cautious. But the opportunity to invest in lagging markets is important. You just showed that the China market, one segment, was up 26% year to date. That's outperforming. But it's 1,200 basis points behind the U.S. market if you look at it over the last 12 months.
Absolutely.
The U.S. is leading confidence. It's had the longest, strongest economic recovery. Confidence is high.
Yeah, I just think buyer beware when you're going to international markets. But let me ask you about something that connects all of it, and that's the dollar. The president over the weekend said, yes, I'm for the strong dollar, but I'm for a dollar that's good for America. What do you think is meant by that kind of talk out of Washington? And does that kind of open the path for, you know, maybe a little bit weaker dollar?
The U.S. Is not looking in multiple ways to strengthen the U.S. dollar. And this, again, is going to be important for the coming decade's performance. Why international markets will diversify and augment returns. You know, look back, for example, at the decade, you know, that ended in 2011. There were very low-risk strategies outside the United States that had extraordinary returns because the U.S. dollar subsided.
But you have to say ending in 2011. I mean, how are we ever going to know?
But these are examples. We've had the third largest bull market in U.S. history in the dollar if we ended in early 2017.
Wow.
The Federal Reserve is no longer trying to force inflation down like it has over most of the last 5 decades. I think a very important thing that happened here, and this is really critical to understanding markets right now, I feel a bit more optimistic about the duration of the U.S. economic recovery. But that's because we had a warning sign. That's because the Federal Reserve, again, was a bit overconfident in 2018 with both quantitative tightening, 4 rate hikes.
By the way, Davos was overconfident too. Yes. I mean, overconfidence was the theme of 2018. So what final word then?
The warning sign helped us take the Federal Reserve from a point of restraining the expansion to protecting the expansion. You just reported on construction activity. Last year was a down year for housing activity, housing construction. We started the year weak in auto sales. We're showing signs that interest rate sensitive activity weakened last year and that we have to be more protective. We need a lower range on interest rates and we need the U.S. dollar to stop going up. And that's going to be to the benefit of those markets that are hurt by those things if they went the wrong way.